The new populist government in Italy has sent a clear signal that they intend to deliver on their pre-election pledges to loosen fiscal policy. The populist government's first draft budget targets significantly wider budget deficits than under the previous administration. A budget deficit target of 2.4% of GDP has been set for 2019, compared to a previous target of just 0.8%. The bulk of the extra spending will be on providing basic income and reversing parts of the recent pension reforms. There is also a high risk of fiscal slippage, given that the budget plans rely too heavily on stronger growth and on uncertain revenue-raising measures such as the tax amnesty. The government is optimistically assuming that their stimulus measures will lift growth to around 1.6% in the coming years. We doubt such strong growth will be achieved. The Italian economy is currently slowing down, with growth already falling back below 1%. The populist government's first budget is likely to be received poorly by market participants, the EU and credit rating agencies. Italy's credit rating was already under review for downgrade at Moody's and is now more likely to be lowered a notch by the end of this month. It would leave Italy just one level above non-investment grade. The European Commission will similarly be concerned that the structural budget deficit is set to deteriorate by 0.8% next year. It would stand in contrast to their requirement for Italy to improve their structural balance by 0.6% each year. The Italian government then has to submit their draft budget plan to the European Commission by the 15th of October. And the deadline for the Commission to publish its remarks on the budget is the 30th of November. The Commission, in our view, are likely to ask the Italian government to correct the fiscal path. The potential for confrontation between the EU and the Italian government is adding to concerns amongst market participants. It has already contributed towards the sharp sell-off in Italian debt and bank equities. The sharp rise in Italian government bond yields reflects both concerns over debt sustainability and redenomination risks. The Italian debt market is currently taking it upon itself to impose some fiscal discipline on the government, which is likely to prove more effective than pressure from the EU alone. It is clear to us that recent unfavourable developments have increased downside risks for the euro. While it is reassuring that negative contagion to other eurozone markets and the euro has been modest so far, it may not always remain that way. The euro could weaken more sharply and fall back towards the lows from last year against the dollar if Italy risks continue to escalate. However, that is not our current base case scenario. Of more immediate concern, though, will be the increased cost of funding for Italian banks, which could result in a less supportive environment for growth.